following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes.
And now, it's time for the show that breaks down the options market. From unusual activity alerts to market updates and trading strategies. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the Option Block. With your host, Mark Longo from theoptionsinsider.com and co-hosts Mike Tosaw from KnowYourOptionsInc.com and Mark Sebastian from OptionPit.com. The Option Block is brought to you by Options Express. Don't spend time worrying about your broker. At Options Express, security, stability, and account protection are the most important responsibilities to our customers. Secure account access, enhanced financial protection, entrusted with over $7 billion in customer assets, established financial stability. Options Express lets you trade with confidence. Stocks, options, and futures, all in one account. Trade with a specialist. Visit optionsexpress.com/OXradio to open your free account. Options Express is a member of FINRA, SIPC, and NFA.
Welcome to today's edition of the Option Block. My name is Mike Tosaw, and I am guest hosting today for Dr. Longo, the Doctor of Style, the man, the myth, the legend. Very big shoes to fill, so I'm excited and honored, but yet humbled to be in the host chair today. Today, we are joined by Andrew Giovinazzi, the Chief Strategist over at the Option Pit. Andrew, how are you today?
I am doing well. It's my first week on the job at Option Pit. I'm having a ball already. So very happy to be there.
And Andrew's a good guy if he can put up with Sebastian all day. So that's something there's something has to be said for that, Andrew.
All day and into the night sometimes. Yes.
Oh
sure.
My goodness, into the night. Holy cow! Seabass trading the futures again.
Just work long hours.
Oh, okay, gotcha. Well, that's to be expected, I guess. Dedicated people work dedicated hours. Yeah. Now, one thing I'd like to say real quick, this is my first day back in about a month. Recently, my wife and I, we've been through some personal times. Folks, my wife almost died on 3 occasions since I've been gone, and she's pulling through, and she's doing real well. You guys, I just want to say a very heartfelt thank you to everyone on the blogs and everyone that's been sending me emails and all the prayers that went out. I know that in the online option world, sometimes it can be very personable, and sometimes you don't see other people, but it was very humbling and very heartwarming to know all the prayers and all the people thinking about us out there in option block land. So my wife is doing much better. She's resting at home right now, but nonetheless, she's definitely on the road to recovery, and I just want to thank everyone for all the thoughts and prayers during that very hard time of life. And the other two people I want to thank specifically are my wife. Number one, my wife stared death in the face 3 times during that time, and never once did she give up on her own life or on the life of our child, with whom unfortunately didn't make it. But my wife proved how tough she was and how dedicated she was and still is to being the wonderful mom that she is. And Kristen, you're my hero, and I couldn't be more proud of you. And the second person that I want to thank through all this is Mike Cavanaugh. He's referred to as Auntie-Mike on the show at times, but Mike, you're a good friend, and I want to just say thanks for taking care of all the money that I typically manage and just kind of being there for me for the day-to-day stuff. Just so a lot of people know, I was still making the macro decisions on a lot of things that was happening in the portfolios, but Mike Cavanaugh was there with me day-to-day, kind of doing the execution on a daily basis, just because of the fact that I was in the hospital with my wife a lot of times. But on a happier note, let's talk about something a little bit happier anyway. Greece. A lot of news going on about Greece right now. It's one that Germany and France kind of got together and said, that they weren't going to give Greece any more money if they were going to try and not accept the money the way that they wanted to, and putting the markets in an uproar. Markets are up, markets are down. Greece is happy, Greece is mad. Greece has a lot of power, Greece doesn't have power. A lot of stuff going on with that right now. Andrew, what are some of your thoughts on what's going on over in Greece?
I find it amazing that they could continually try to move the ball. Okay, they have a deal. They had a deal last year. Now they have a deal this year, this month. And Greece somehow kept finding a way to move the ball somehow. And I think finally the Europeans have just decided, you know what? Europe will survive without Greece, but we're not so sure Greece is going to survive without Europe. And I think they just finally let them know. No, and they're at the point now where they're like, this is ridiculous. You know, we're not going to spend all this time, energy, and money on this anymore unless you guys are going to come to the table. You have to give up something because you guys have been living living high for way too long, and that's just it.
I think so. I mean, I think it's interesting. I agree with you totally on that. I think it shows how truly messed up not only our financial situation is, but our world is when the country that is in debt, the one that is supposedly causing all the problems, uses the fact that they have all these problems to lever themselves into possibly getting more free stuff. And they actually moved the markets with doing this. Now, it does seem that Europe's finally saying, all right, guys, enough's enough. But I think it's just amazing the situation of the state of our world is when something like that is able to even happen. I mean, can you imagine this? Say, just think about 100 years ago, if you're out on the streets and you owe somebody a bunch of money and you say, nope, I'm not going to accept this bailout. I want a better bailout.
I know. It's just, also too reminds me of like the Latin American debt in like the 80s, late 80s, when I was just kind of starting out. I am that old, but, the great line was the Citicorp telling Latin America, you owe us a lot of money. You guys have a problem. And then Latin America saying, well, we owe you so much money that I think we both have a problem. And I think that's what Greece tried to do, and they tried to play that as long as they could. And there's just no reality from their point of view on how much they are. That's basically how much they deserve. I guess they keep thinking they deserve more and more and more for some particular reason, which I don't think anybody's been able to figure out yet.
All right. Now, moving on, a couple of other things that happened today. Had a little bit of movement in the VIX. Notice on the S&P 500 itself, I'm just looking at the SPX closed up 23.25 points today. The VIX, actually the cash VIX, I see moved 2.3, a little over 7%, a downward move. And Andrew, just curious if you had any thoughts on the VIX movement, the relationship to the VIX and the market itself.
Right. Yeah. Usually, we want to see the S&P up 1%. VIX should be down about 6%. So it looks kind of like the VIX in general was kind of hedging its bets a little bit. There wasn't that giant relief sell-off in the VIX that we saw last week when we had that just very, very, very dramatic fall off. What it is this is more of, okay, we see things are better. Okay, the Greeks got slapped, the market's going up. We love all that, but we're just not going to go and sell it, right? We're not going to go sell the volatility. What's going to happen is this is more to me like the bids coming out of the volatility. There's always that transition in the market where if people want it, they lift the offer and they buy it, basically, and that drives volatility up. And then, but if they don't want it, they just back off the bid. And it's a gentle change in the way people think of volatility. It does make a big difference. But if people's actually selling the bid, then you really see things starting to go down. And I don't think we're seeing the selling yet. I just think the bid is just becoming a little less stiff.
Gotcha. Now, are you and Seabass looking at any opportunities right now in any of the VIX options that you're trading, or the VIX futures, or any of the VIX products at all?
Yeah, actually, the trade that Mark liked is he actually had the time spread in the VXX sort of below the strike, kind of expecting the VXX to come down by buying the time spread, way below where the current price is. He was expecting the VXX to come down, expands the value of the time spread, and also pounds the November down. So he gets kind of the double whammy. So his idea was, and it's working pretty good, get long that out of the money time spread, but well below where the VXX is currently trading. And as it drifts down, that time spread will expand. He unwinds it, he makes money, and of course, everybody's happy. So that's a way he thought to play this, and I thought that was a pretty good approach.
Yeah, it's weird. I've noticed that in this business, when people make money, they do tend to be happy. It's kind of a weird phenomenon.
It's amazing, and clients call back. You get you get repeat customers. All kinds of things really go well when people are making money. Yeah, you're right. You're definitely right about that.
That's interesting. Energy. It's something that I noticed today. I'm just looking at in my beloved sectors. I'm noticing that XLE is up over 2.5% on the day. With that, I think that I'm looking at a lot of our energy stocks that we have a position in. There's definitely a lot of movement in energy today. So I think that right now, the other thing that I'm personally finding interesting is that if it feels like things are getting better, we're flocking to energy. So let's say, for example, that just from a macro level of the world as a whole, okay, life is getting better, things in Europe are stabilizing, markets are going to be efficient now. Well, if that's the case, people are going to need to drive cars. People are going to need to use energy for a lot of things to work. Because what really drove down energy a couple of years back in the days when oil was up at $147 a barrel, it wasn't necessarily energy going down. It was just the demand for it going down, just because of the fact that no one was using it. So what I'm finding interesting right now in the energy world, if things do get better, I am definitely a bull on energy. And today's is definitely an example of that. Energy of all the XLE, XLF, of all the select spiders, that's definitely leading the way. So energy is another thing that I've been looking at today. Oil's up. It's not up an extreme amount, but it is up nonetheless. It's up $1.50 a barrel in the December contract. But nonetheless, energy is something that's been on our radar lately. You and Seabass looking at anything in the energy world at all?
Nothing much in energy, mostly too, but it's darn cheap, like PE wise. With oil up here at this level, it's still all across the board for this particular area. It is a pretty cheap sector, and also you're having a little takeover effect. El Paso was just bought, last week and things like that. So, this is the time where things get cheap. If things start to look a little bit better, obviously you shouldn't buy stuff on takeover, but the sector is starting to pull together a little bit.
Most definitely. And then it wouldn't be a day of Mike Tosaw hosting at all if we didn't talk about the metals at all. Gold's up a lot. Gold closed actually the highest. I forget what the statistic was, but it's the highest it's been in a while. I forget if it was a few weeks, a month or so. I could probably bring up a chart and check it. But nonetheless, gold is coming around again, as is silver. I think that, my humble opinion as to why this is starting to happen again, I think we just had a pullback in the metal world a couple of months or a month or so back. I'm still a long-term bull on gold and silver, and I think it's starting to claw its way back. Since the last time that I've been on this show, we've definitely had quite the rally in the metals, and I think we're going to continue to go higher over the course of the long term. What I think is interesting, what I have been seeing lately in my collar world, we've been looking at a few more weeklies, and it looks like premium is starting to get a little bit higher in the weeklies because we're actually using weeklies in our collars right now. We typically prefer not to do that, but if the premium is there and if it lines up, we do it. Our basic methodology, we have other things with which we do, but to summarize what we do in terms of which options we use, we look between 1 week and 3 months out, whatever the best deals are, whatever the cheapest puts are, and whatever the most expensive calls are, and that's kind of how we work it. Now, we look at other things too in terms of potential events. We look at the chart. We look at a lot of other things. But in general, what we've been seeing lately is that the premiums in the weeklies, at least on GLD, has been high enough for us to justify actually using some of the near-term options in that world. Now, have you guys been following anything on the weeklies at all in the metals?
Well, you know what, too, I've noticed is just the shorter-term historical volatilities of the metals have slowed down a little bit. So it makes that weekly trade look a lot better right now. If GLD isn't moving so much, this certainly you want to move in a little closer on the expiration cycle. So it makes sense to me. Mostly we've we've been looking more on just regular stocks and looking for basically the event of volatility to come in. So as far as gold, I was watching it a couple weeks ago, but it wasn't doing wasn't doing enough interesting for me yet. But just looking at these lower volatilities, it actually starting to look a little more interesting again. Lower underlying volatility.
Gotcha. All right, and that will conclude today's trading block. What we're going to do today, folks, we're going to do a little bit of a different format. We're going to kind of play to the strength of our host and guest. We're going to have an extended strategy block session. So let's dive into the strategy block.
The strategy block.
And let's start our strategy block. The strategy block is where typically either myself or another one of our hosts discusses a strategy with which we are using. Today, Andrew is going to enlighten us on the uses of one of my personal favorites, the beloved front spread. Andrew, let's discuss the front spread.
Okay, the front spread. So the front spread, as I know it, is generally some kind of ratio spread. It has many different forms, but I think the most identifiable is the old 1x2 call spread, where you're buying one option and you're selling two. That's how I start my idea of what a front spread is. And generally, what you want with a front spread is you want volatility, implied volatility. That's the options that you can buy and sell to be, relatively high, and you want the historical volatility of the actual underlying of the stock, how the stock moves. You want that to be, cheap, right? Stock doesn't do anything, options decay, everybody wins and they're thrilled. Kind of almost alluding back to the gold collar, where you get the gold underlying wasn't moving much, and the weeklies look like a good collar because the premium looks relatively expensive. But here now, we're trying to figure out, and I think one of the things now is almost the entire market looks like you want to be front spread. The problem is you have this grease thing, right? So how do you pick a front spread? So an idea we were tossing around today was a stock where they've kind of pre-announced news, but the volatility is still relatively high. So we actually had a candidate like this was Abercrombie and Fitch, where the implied volatility is still relatively high in the mid 50s for that stock. Abercrombie cracked up today on a pre-announcement of earnings. It's not the full earnings report, but it was certainly bad enough to send the stock down $15. Okay, so I would say some kind of news came out, right? So they pre-announced earnings, and what that did is it's left the implied volatility pretty high. Now, the grease thing we understand, right? That on any given day could move things around. But the good thing about the 1x2 is it does give you a little bit of a cushion, right? You're not just flat out selling options. You're long an option into the short two options. So you still have a little bit of room in a position like that. So the idea with Abercrombie and Fitch, what we looked at is, okay, stock's down $15, probably isn't going to cover that gap no matter what kind of news they come out with. So the idea was buying a out of the money call, like around a 62.5 strike, and selling a couple of the 65s for a credit. So you've got a little short, synthetic short on in the underlying, still giving the underlying room to come back up. And it's a way to kind of capture $1 or so and wait for that compression. And possibly if the stock starts to come back up through the December cycle, the play was on the D cycle, you actually have room to make actually some pretty good money on that spread. So when I look for a front spread, I like to put it in the context of what's going on. And I thought, since we did get the pre-announcement, a lot of uncertainties off the table, besides, of course, Greece and all the other stuff. But it looks like a pretty good candidate. So that's a trade we talked about today at Option Pick.
Oh, very good, very good. Now, with that, I'm going to talk about the back spread, kind of. I have a strategy that I use as kind of a modified stock repair strategy. It is a front spread. And as I get into this today, I'm going to talk about hedging a front spread with a back spread. It's going to get kind of deep, but we'll do what we can. XYZ stock is a long-term holding of mine. It's always been my all-time favorite stock because XYZ stock does everything exactly as I like it to do. XYZ stock goes down in value a little bit. And let's say I own 100 shares of XYZ stock. I'm still a long-term bull on XYZ stock. However, it's down from 50 to 40. So one thing that I care to do with XYZ stock, it's kind of a modified stock repair strategy. I like looking at calendars and diagonals. I like looking at verticals. I like looking at a lot of things. But in this instance, the tool of choice is going to be a ratio calendar spread. XYZ stock is down at $40 a share. And I'm still a long-term bull on it. And we'll just assume that the stock's in an IRA for right now, just because of the fact that I don't want to mess with taxes in this illustration when it is something that you need to consider should it not be in an IRA. What we're going to do is we're going to actually buy the XYZ 45 call option. We're going to buy one call option, and we're going to pay, we'll say, $2 for it. Now, with that, we now have double leverage from 45 to infinity and beyond. Hopefully I'm not infringing on a trademark with that statement. But my point, the bad news about that is the fact that we had to pay $2 for that call option. And we're going to get bit with time decay, with potential volatility risk, all sorts of fun stuff. And we don't want to do that. So what we're going to do is simultaneously sell not one, but two November 45 calls. And we're going to collect $1 each for them. Now, since this is XYZ stock, I can make everything sound all rosy and easy math. In the real world, sometimes you have to pay a debit for this, and sometimes you can get it for a credit. It just depends on the right situation. Typically, my guideline is I like to make it around even money. I've done these for credits. I've done them for debits. I've done them for even money. Just whatever works best in your situation. So the two November calls that we sold for $1 each finance the cost of this January call that we bought. Now, let's start by going with the ultimate hope for this trade. The stock's either going to go up, down, or stay the same. Let's start by it staying the same or going up to $44.99. Well, if that's the case and we take absolutely no action, at the end of November, those November calls are going to expire worthless. And with that, the January call is still in effect. We didn't pay anything for it because our November obligations are all gone, and we now have double leverage on the stock itself. So let's say the stock does continue to go up from $44.99 up to $50. Instead of us being just back to break even, we're actually $5 ahead because of that call option. So that would be the ideal thing that we would like to happen. If the stock stays the exact same at the 40 level, well, same concept. You now have a free call option. If the stock starts going down, you have to go back to your original risk management plan of when were you going to get out of the stock in the first place. That's a strategy for another show. But my point is if the stock stays the same or goes higher, this can still be a beneficial strategy for you, and you can create some pretty nice leverage on it. Now, the problem with this strategy is when it goes above the 45 level when you are still in the actual November expiration cycle itself. Now, strategy one, what I just talked about, it's very common for me to do. I like doing it all the time. The first mechanism of defense that I have against a stock rising too quickly would be to buy to close the November calls and roll them up and sell to open maybe some 47.50 December calls, possibly at even money, maybe even a small debit. That way, yeah, we'll have to wait another month until those calls that we sold expire, but we have a little bit of upside. And then if they continue to go higher to the 47 level, then you have the ability to roll into a January 50 call, let's say, and you basically have a vertical 1x2. And you'll still be at a point come January that you'd be profitable if it was higher or even above the 45 level, but it wouldn't be ideal. Ideal would be to just have it expire below the 45 level come November. Now, if it does go above 45 too soon, folks, this is a good problem to have. It's just a complicated version of selling a covered call and having that covered call go in the money and you getting your maximum profit too soon. Now, I have a strategy that I do probably about once a year. Not because it's my all-time favorite strategy by any means. I actually prefer not to do it, but this is one of the tools that I use. It's kind of like Grandpa's old saw that he uses just every now and then when he just needs the right fit for the right situation. And over the course of the last 2.5 years, I just put on this strategy for the second time, just probably last week, actually. What we did on XYZ stock, I'm not able to disclose the exact stock it is because typically I do different things for different people, and we didn't do this for everybody. So I'm just going to leave it at XYZ stock for right now. We actually use a vertical back spread if it's available. So XYZ stock went up to around the 46 level. It gapped up one morning. And so what we did is we actually bought 2 47.50 calls, and we sold 1 42.50 call. And once again, to quote my hero Joe Friday, the strikes and the stocks have been changed to protect the innocent. So as we did this, we now have a hedge to the upside. So let's say what we need to figure out right now is what if the stock goes up? What if the stock goes down? What if the stock stays the same? The stock goes back down. We set the back spread up in a way to where the premium we collected from the 42.50 calls will cover the cost of the premium that we bought in the 47.50 calls. So if it goes right back down, we'll be probably about break even on the back spread. The front month calls on the front spread expire worthless, and we're still in our ideal situation. Should the stock go higher? We're going to lose money if it goes up a little bit. But let's say the stock just bolts on up to $62. Well, with that, remember a back spread, all it is it's a modified straddle, folks. The back spread will mitigate the fact that we are losing money on the ratio front spread, and we have something in place to where we can not lose, we can still participate to the upside on the stock itself. Now, let's say the stock stays the same. Well, if the stock stays the same, you're going to lose money on the back spread. Back spreads are something to where you're going to want a lot of movement. And when you're doing a back spread, it means that you want the stock to move a lot one way, but if it does move a lot the opposite way, you're going to make a small amount of money or maybe even break even depending on how you set the trade up. The enemy of the back spread is non-movement. So, since that's our enemy, we also have another spread on the table where non-movement is our friend, and that's the front spread. What we can then do, the money we make off of that front month call gives us the ability to mitigate a lot of the losses in the back spread should it actually happen. And then come December, we can sell some more calls again and start the process over, probably at a higher strike price. So with that in mind, there's a lot to this strategy, and I'm typically not a fan of trying to get too smart, if that makes sense. But if the situation arises and the prices make sense on the back spread for what we're trying to do, I will use that strategy. And that is one to grow on. And now let's do the Around the Block segment.
Around the Block.
And welcome to the Around the Block segment. This is where we talk about what we are looking at in the marketplace. Andrew, what are you guys checking out over at the Option Pit?
I think at Option Pit, Mark was looking at weekly trades, weekly flies that he blogged about this morning. I think they were working out okay the last time I looked. There was some questions, like I said today, about back spreading and front spreading. So you discussed sort of the front spread idea. What I did is I tried to come up with some back spread ideas, and one of the ones that I picked was in the financials. So because the financials are so prone now, there actually is some opportunities because the volatility in there is at least to a point where it's cheap enough because they're moving so much. Just the hard part is is which ones do you pick? So I try to pick stock, let's say like Morgan Stanley, like backspreading the 17 line in December, where you really, because the financials are so geared to what's going on in Europe, they have the chance to really bounce up or down, because if they kind of blow the all clear sign, that's going to take a lot of immediate heat off the financials. And a stock like Morgan Stanley was $31 or something this year in February, down to $16 now. That's the kind of name that could pop. So you're trying to find a name that has an arc enough to make a backspread pay. So we were contrasting backspreads, like I said, a Morgan Stanley with a front spread in something like an Abercrombie and Fitch, where you have kind of scenarios and try to put the trade on to fit the scenarios, that the market was giving us today on this, like, sort of this better grease news.
Sounds good.
That's what we had going.
All right. And what events, what webinars, what seminars, what do you guys got going on over at the Option Pit? We're
going to be at the Money Show in, let's see, November. Let me look at the schedule. It's like the 15th to the 18th. We'll be in Vegas. We'll have a contest and teaching. Basically, you get Option Pit stuff. You win a Kindle Fire. If you have 3 days, who can make the most money in 3 days using standard trading platform and just go at it. So the winner gets about $1,000 worth of stuff essentially. So
that's a pretty cool deal.
Yeah, it's not too bad. It's not too bad. Also, we are giving a VIX talk in early December. Sponsored by the CBOE and TheStreet.com and Option Pit. Mark will be one of the headline speakers on using options in the VIX to hedge, speculate, whatever, but just really giving you a solid overview on how to use the product's contracts, to shape trades, based on what you think is going to happen. So those are two pretty good events for us. We got November. And, obviously then in early December. So we're keeping busy.
Sounds good. Well, over at Know Your Options, we're watching everything these days. One of the key things that we are really taking a look at, obviously, is Greece. I think that's the one that we really need to keep an eye on. We need to see if the Greek prime minister is out or not, if they're going to oust him or if they're going to let him stay or whatever deals they're cutting. I think Greece is the word. Too bad Sebastian's not here for the references, but I guess that's 70s, so that's a little bit before his time. But
yeah, I actually did a post, a trade for options profits, the Street's option profits. Where I said Greece is the word. I couldn't help it, but it was the catastrophe last summer. It wasn't even this summer's catastrophe. They've been doing it for so long.
It's really the word.
It has been the word. It's ridiculous.
It's nuts. But anyway, at Know Your Options, we are doing a strike price selection webinar this Sunday night. So for more information on that or any of our other webinars, feel free to stop by knowyouroptionsinc.com. On that note, folks, I would like to thank everyone for coming. I'd like to thank Mr. Longo for letting me sit in the host chair today. And folks, let's have a successful trading week. So long, everybody.
Become a part of the Option Block. Just visit www.theoptionsinsider.com/forum to post a question for the hosts. You can also submit questions to twitter.com/optionblock or leave a voicemail at 312-544-9356. Make it interesting and your question just might make it on the air. The Options Block is property of the Options Insider Incorporated. All rights reserved. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.